Journal means primary book of accounting. If you are capable to identify this is the transaction, you have to record as primarily with short explanation date by date. This is called journal. So journal is the primary book of accounting. Transactions are recorded with short explanation date by date. Date by date means chronological order. This is the primary book of journal. There are some characteristics of journal. At first, chronological order, double entry system, day book, day by day you have to write here. Compound entry possible, assistant to ledger, transaction identify, original entity, includes brief explanation. That's what short explanation. This is the criteria of journal. Now I am going to discuss about types of journal. There are two types of journal, general journal and special journal. General journal means normally we just record and primarily. This is the general journal, and special journals, special types of transaction or special types of accounts we need to record in this book. There are basic definition about the general journal. General journal is accounting diary, and normal journal, the transaction occurred as soon as possible we try to record. This is the journal and general journal. General journal we can divide it 5 category or 5 head. At first, transaction entry. Transaction entry means a normal journal. Transaction occurred, we try to record in the primarily. And adjusting journal is very important. Adjusting journal is the journal that need to record at the end of accounting period and try to know the update of revenue and expense according to the actual basis. So adjusting journal means you just adjust actual revenue and expense to know the update of accounting. This is the adjusting journal. To be adjusting journals, there are 3 criteria must be occurred. At first, this entry you have to record at the end of accounting period. Number 2, to know the update revenue and revenue expense in current year. And this record or transaction you have to record on the basis of accrual basis. Accrual basis means you just try to identify the transaction is recognized or transaction is occurred, cash payment or cash received instantly maybe or not. Okay, so this is the accrual basis. So to be adjusting journal must be considered 3 items or 3 points. At first, this journal need to record at the end of accounting period. Number 2, you have to update revenue and expense. And 3, this journal follow the accrual basis. Accrual basis is the transaction, just you need to recognize the transaction is occurred, cash payment or cash received in future. This is the accrual basis. So to be adjusting entries, there are must be 3 criteria minimum. Okay. Then closing entry also need to record at the end of accounting period, but the closing entry you have to record the temporary account to permanent. Temporary account you have to post to the permanent account, and there are a specific income summary. Just close the entry in this journal. You have to need to close the entry in this journal. Close means temporary accounts. Temporary account means expense and income. You have to close at a certain period. when you try to close the transaction at a certain period, you have to record under a specific heading or summary. This heading or summary you can call income summary. So you can call closing entry very simple. All expense and all income need to close at the end of accounting period under the income summary statement. This is the closing entry. Very simple. And item number third, compound entry. Compound entry means when a transaction need to more than two account, more than two account. This transaction you can call compound entry. And finally, reversing entry. Reversing entry just reverse or opposite of the adjusting entry. Adjusting entries need to close or cancel at a certain period. In this time, you have to need a reversing entry. Reversing entry is just opposite of the adjusting entry. There are two criteria to be reversing entry. Reversing entry, you have to post at the beginning of the new accounting period. And second criteria, only certain adjusting entries are reversed. Not all adjusting entry need to reverse. A certain adjusting entry are need to reverse. Which item or which entry need to reverse? Those adjusting entries are payable in future. Such types of adjusting entry need to reverse. Say for example, accrued expense or accrued income types of transaction need to post reversing entry. So you try to mind it, accrual income and accrued income and accrued expense. Accrued means payment will be in next or payment will be received in next, not instantly currently payment. Okay. So this is the accrued. So accrued income and accrued expense class entry need to reversing entry. So this is the 5 types of general journal. Now I am going to discuss about compounding entry. Compounding entry just same transaction need to more than two accounts. So here are three accounts, same transaction. Cash account, note payable account, and purchase account. The three types of account, but say single transaction. Single transaction when you need to more account, these types of transaction is called compounding entry, journal entry. Another types of journal, special types of journal. Special types of journal we can categorize under four head: cash payment journal, purchase journal, cash receipt journal, and sales journal. Cash receipt journal, only cash receipt related transaction you have to need in this journal. Cash payment journal, all cash payment transaction need to record in the journal. Purchase journal, all purchase need to record in the journal, and all sales need to record in the sales journal. So same category or homogeneity transaction record in a special journal. So this journal is called a special types of journal. Now I am going to the chart of journal. There are 5 columns of journal. First column date, second column description, third column post reference or reference, fourth column debit, and fifth column credit. This is the chart of journal or journal entries book. Now I am going to golden rules of accounting. Golden rules of accounting. You have to memorize or clearly understand about these rules. If you are failed to understand these golden rules, you cannot solve a mathematical problem. So I humble request you to deeply keep attention on this slide. This is the golden rules of accounting. So there are three types of account: real account, personal account, and nominal account. Real account means asset, all asset, real account. Personal account, any person or institution name. Nominal account, all expense or all income. This is the nominal account. So you have to you have to learn why and how we treat or we post by debit and by credit. So when you face to face with the real account will be debit. When what comes in any types of real account comes or increase, debit, and goes out or decrease, credit. All real account. Real account means asset. Real account means asset. There are some example of asset. Try to follow the bottom of the slide. Cash, land and building, plant and machinery, furniture, fixture, trademark, etc. This is the some some example of asset. So a lot of our huge there are asset. So if we classify the asset, there are two types of asset: tangible asset and intangible asset. Tangible asset, those asset we can touch and see, and physical existence. Tangible asset. Intangible asset, those asset we cannot see, we cannot touch, just we feel. This is the intangible asset. So there are here mentioned some tangible asset and intangible asset also on kind trademark. Intangible asset we cannot touch, we cannot see, just feel. Okay, say for example, goodwill, trademark, loyalty, logos, brand loyalty, software, like this. So this asset comes or increase, debit. This asset decrease or goes out, credit. And personal account, receiver debit and giver credit. Personal account. Personal account, what is personal account? Personal account, name related. So personal account we can categorize under three categories. Number one, natural personal account. Natural personal account, directly any individual name. Okay, say for example, Aman, Ram, Son, like this. And artificially personal account, any institution. And account, representative personal account, those account that are carry the outstanding accrued or advance of nominal account. If the nominal account carry the name at first, accrued or advance, these types of nominal account is called representative personal account. So personal account, giver credit, receiver debit. And nominal account means all expense and loss, all income and profit. These types of account we can call nominal account. Nominal account always time if expense or loss occurred, debit, and income and profit occurred, credit. So these three account you have to clearly try to understand. If you not clearly understand this formula, you cannot solve the mathematical problem, especially journal entries. So I think you deeply follow the golden rules of account. To understand the golden rules of accounting, you have to recognize asset, personal account, and nominal account. Which account will be personal account, which account will be nominal account, which account will be real account. You have to first recognize or identify. Other else you cannot solve the mathematical problem. So in this slides, some example I try to highlight asset, personal account, and nominal account. Nominal account means all income and all expense. Nominal account example: salary, wages, purchase, sales, and commission receipt, and so on. This is the nominal account. So it try to briefly follow nominal account. Asset comes debit, goes out credit. Personal account receiver debit, giver credit. Nominal account all expense and losses debit, all income and profit credit. You have to clearly understand this three item. So now I am going to solve the simple journal. This is the example of journal transaction. Now we solve the transaction under journal entries or journal book. Okay. So here are first, I try to read the math. The transaction of Mr. Robin, an interior decorator, in his first month of business are as follow. Mr. Robin is the owner. He want to keep the record of interior decorator shop. Some transaction are occurred in the month and try to keep the journal book. At first January, Mr. Robin invested taka 20,000 cash in business. Mr. Robin start business by invested in his business. So he brings cash amount in starting time of the business. So bring cash in business. So for example, cash are increase in business. Cash is the asset. Asset comes or cash asset increase debit. So cash account debit against capital account credit, because the owner give anything. You you have considered as the capital. Owner give anything. You have to consider as capital. Okay. So owner, Robin is the owner in this business. Robin give the cash money. So cash money, one side cash increase or asset increase debit, another side liabilities increase. Liabilities increase mean capital. Capital is one kind of liabilities. Okay. So liabilities increase credit, asset increase debit in this journal. There is a solution. There is a clearly explanation. Cash is one kind of asset. Asset increase, so debit, and owner's capital increase the amount 20,000. Owner's capital is credit, is one kind of liabilities. So the simple solution: cash debit and owner's capital credit. This is the first transaction of the journal. Second transaction, January 1st. Purchase a used van for taka 5,000 cash for use the business. Purchase a used van. Used van purchase. So for used van increase. Used van is one kind of asset. Used van is one kind of asset. So asset comes in or asset increase debit. So used van debit. Against you give the cash money. So cash money is one kind of asset. So cash asset are goes out. So one kind of asset comes in and another types of asset goes out. So comes asset debit, goes asset credit. So comes asset use van debit, and cash goes out. Cash is one kind of asset, goes out credit. So use van debit, cash account credit. You see that solution: van account debit, cash account credit. Okay, explanation there clearly. Van is one kind of asset. Asset increase debit, and cash one kind of asset decrease credit. Okay. Transaction number 3, that's means January 8. Purchase supplies on account for taka 600. Purchase supplies on account. You have to memorize on account and on credit. On account and on credit means not cash in payment and cash receipt instantly. Not payment and receive cash instantly. This cash will be payment in future, or this cash will be received in future. That's mean on account and on credit. You have to clearly mind it. On account. Okay, on account, on account. On account means not instantly cash payment or cash receipt. Cash receipt and cash payment will be in the future. This means, okay. Your purchase supplies. Supplies one kind of asset. Purchase supplies increase. That means asset increase. That's mean asset income. Asset income. So asset come means debit. Supplies debit, and one account. Purchase by one account. Purchase by one account. The arise a account payable or not payable. Account payable, and all payable are credit. All payable are will be credit, because payable means liabilities. Payable means liabilities. Okay. Payable means liabilities. Payable arise from purchase on account. Okay. So the solution of the transaction: surplus account debit, account payable credit. January 8 is see the solution. Surplus account debit, trade creditor account credit. Trade creditor is a British language, and American language account payable. Account payable and trade creditors same, no difference. One country use payable, another country use creditor. Okay, no problem. Transaction 12, prepaid a bill to customer. Ready a bill to customer, taka 2000 for service provided. Service provided. So you service provided. You service provided, but you take cash. But in this time, you not receive a cash. You just prepaid a bill. Okay. So ultimately, it is clearly understand that cash receive in future. Cash receive in future. Because service provided, but bill prepaid. No receive money or no payment money or cash. Okay. So bill ready. Service provide, you service provide, but ready, prepared a bill. So ultimately, clearly understand about this. Now service provided, but cash receive will cash cash will receive in future. That means account receivable. Re, cash receive in future, account receivable. Cash payment in future, account payable. You mind it. Account receivable and account payable. Account receivable always time asset, account payable always time liabilities. So you mind it. Cash receive in future, account receivable. Cash payment in future, account payable. So account receivable debit and service revenue credit. This 12 January transaction. This account receivable AR debit and service revenue credit. Account receivable the one kind of asset. So asset comes in or increase debit, and service revenue is one kind of income. So income or gain credit always time. So service revenue account credit. 15 January 15 January paid taka 500 cash for advertising. Advertising is one kind of expense. So all expense are lost debit, and cash payment for advertising. Cash is one kind of asset. Asset are decrease or goes out from your company. So advertising expense debit, cash account credit. 15 January. And 21 January, receive cash 800 cash from customer bill on January 12. So in January 12, you prepared a bill to receive money in future, but in January 21 now you receive money. So you receive money or cash. So cash increase, cash one kind of asset, cash asset increase or asset comes debit. So cash debit and account receivable credit because you collect the money from account receivable. So account receivable is one kind of asset. This asset are goes out or decrease. So account receivable is credit. And last transaction, January 30, withdrew 50 100 cash for personal use by Mr. Robin. Mr. Robin are withdraw or taken money from company. So taken money withdraw less time debit, and he take cash money or cash that goes out from the company or cash. So this cash is credit and withdraw is a debit. This is the final transaction of journal entries.